And now it's time for my favorite beat, the Wall Street beat. And once niche stock trade known as dispersion has ballooned into one of the biggest option strategies on Wall Street, and now it's stirring fears that it will be crushed by its own popularity. Bloomberg's Justina Lee, all over this industry, joins me from London on her story, of course, one of the most read on the Bloomberg terminal. And it really raises the question, Justina, on what the biggest worry is about this trade.
Yeah, I mean, I think it's a classic Wall Street cycle in that it did really well kind of around 2022. So anecdotally, a lot of money kind of went in, via multi-manager hedge funds, maybe through bank swaps. And so now people are really worried because if you look at the charts, it shows that the cost of entering this trade is the highest since at least 2011. Now, it's still making money for now, but that means that if you get into the trade at this moment, you're really counting on this pattern continuing.
Now, maybe it's worth taking a step back also and explaining this trade. You've written that assets have nearly tripled by some measures, but what is it doing exactly for investors?
Yeah, that's a great question. I mean, I always feel bad when I go on TV to talk about options because it's very technical, but I'll try my best here to simplify. So basically, you're buying single stock options and you're selling index volatility, so index options. And the reason that's supposed to work is that there are always a lot of people who want to buy index options from you, as a hedge. But at the same time, because stocks kind of move around and then they kind of cancel each other out. So meaning, there's kind of some correlation between them. So a single stock vol usually ends up higher than kind of index vol, and that's sort of the basic reasoning of the trade.
Well, does that essentially imply that you're short volatility here? Because in the last year, that has generally worked out for you. In the last 5 years, it's also directionally worked out for you. But we are headed into an election cycle, and we are headed into other potential things that could really start to shake things up under the surface. With the VIX at 12, being short feels fine. But what about the rest of the year?
Yeah, no, that's a great point, because that is partly why this trade has been so successful, because we've had these big moves at the single stock level, think Tesla, Nvidia. But at the same time, on an index level, volatility has been really low, because we haven't had a lot of demand for hedging. Even in 2022, when the S&P ground down, we haven't had any big macro shocks. But if you think about it, you've made a lot of money on your stock portfolio. Stock hedging is now pretty cheap, and so we have an election coming up, and so it's a pretty good time to kind of start hedging your portfolio again, and that could be a problem for the dispersion strategy.
Do you think, Justina, it also kind of shelters or covers up the real volatility that's under the surface? Because if you're looking at the VIX and see it hanging out around 12, you're saying, okay, maybe things are kind of calm under the hood, but if all the activity is happening in options, then is everything really being fully reflected?
Yeah, that's a big question here, and I think it's a big debate in the options world, because there is one argument that all of this kind of index option selling, dispersion is part of that, actually kind of creates this self-fulfilling cycle where, a lot of people are selling vol, and so the price of vol goes down, and so you kind of feel like, why is the VIX so low? Now, obviously, this cannot really sustain itself in that if we do get an economic shock, if we do get any kind of big surprise in markets, ultimately volatility has to spike. But then I think it is probably true that, all this index vol selling probably does have some effect, as long as things do remain kind of relatively calm.